Joining us from London, James Butterfill, Global Equity Strategist at Coutts. So, James, you were correct to make that call. I think now the big question is, what happens next? In this environment in Europe where we actually have an improvement in the business cycle, but sovereign bond yields are going down, and there's concern about how big this deflation story could get. So what do you think will be the next move by Mario Draghi?
Well, I can understand why the market's concerned. Initially, there was some form of euphoria, but then it's the first time, I suppose, the ECB has acknowledged the D word, the nasty word, deflation. And that was obviously why equity markets fell as a consequence. And what will he do next? Well, he's cut the interest rates. There's potential that if you look in the periphery, for instance, where there is the most weakness, if you look at corporate earnings results, its financials sort of really hurt, particularly in Spain. So, and I suppose another part of disappointment from Draghi was he didn't mention any more LTRO. So, where do the markets go from here? Well, what we know is that small to medium enterprises comprise around 70% of GDP in the periphery, and around 40% of those have virtually no access or very impunitive access to credit. So cutting or improving loan collateral requirements or reducing loan collateral requirements for SMEs could be his next step. And just uttering the D word, the deflation word, suggests that he will continue to be more accommodative and think of perhaps more imaginative things to do.
Just two questions. Was cutting the rates now better than cutting in December? Does it send out a more positive message to the market? And also, is it possible that he might, in fact, send the deposit rate down to negative?
Yeah, that both are quite possible. Cutting now is, we were concerned he might leave it a little bit later. They have tended to be a little bit more reactive than proactive. Perhaps this now is being a bit more proactive, and this is needed, and why in the long run this could be positive for equities.
You agree with that, Mikio?
Yes, I do agree with that. At least with the last part of the sentence, which is that it's good for European equities, I presume.
Yeah, and James, getting back to this European story, what's been interesting is that so all of a sudden he cuts rates, the markets initially rally, and then they look at the headline U.S. GDP figure, and then all of a sudden start fretting over taper. We're running up to U.S. jobs later. So if this number even meets expectations, somehow does the European story hinges more on what's coming out across the pond?
Certainly there is that currency trade-off in the US versus the USD versus the euro. We expect perhaps numbers to be a little bit softer in the United States. I know a lot of people are now putting tapering back on the agenda. We still believe it will be March just because of the practicalities behind tapering in January. I mean, Yellen is being inaugurated. They've got the debt ceiling debate rearing its ugly head again in February. Just doesn't seem practical to occur in January. So we continue to believe it will be March. And again, that should be positive. And we feel the markets will slowly understand that. And so it should, again, yes, be positive for equities. But in terms of that differential between the US dollar and the euro, there certainly will be winners in Europe and losers. So those that have a lot of dollar revenues are likely to really benefit. So automakers, for instance, should do quite well. On the flip side, airline companies which have a lot of dollar expenses, perhaps that's going to be a bit tougher for them.
Absolutely. Certainly a weaker euro is going to help a lot of the exporters wherever they are. Nice to hear your thoughts, and we appreciate you coming in bright and early for us. Pleasure. James Butterfill of Coutts. And we've got to say goodbye to Mikio as well. Mikio, you have a fantastic Friday afternoon and weekend there over in Hong Kong. We'll talk again very soon.